Erica's a little bit outside.
What?
Yeah.
Okay.
I saw you forwarded an email. Not yet. We'll get there.
Good afternoon. So this is the first day we're instituting the city management program. So there's no more seats left, which I don't know. I don't think there are any more seats left. So there's one seat. Somebody can sit here. You can use these two seats. Other than that, special exceptions for CAs. Yeah, the extra people are over there. I'm just going to take a peek.
挺好的，你看后面我看也挺听话的。
Ja, oh, they think so. You know, some other students have some opinion about it. Why just for us? There, huh?
公园我还好久才能到，最近扭了大概半个月，妈那个挺可能因为热毛巾，半个月也是挺不错。我是跑步跑了擦扭的，然后就扭
So
了
when
半
I
个
was
月
over there, I
不
was
是
hearing.
Well, yeah. No, just because it's a minute behind.
See.
The lecture's out there.
Whatever. One of the TAs said, "
你在理化的生化是老师和计划型，好默契。
Yeah.
Yeah, we do check.
应该是有人讲。
So, okay, I just want to make an announcement that at the end of class today, there will be a special seminar that's open to anybody. It's a seminar of the real estate program here, but it's open to anybody. And it's about hotel real estate, investing in an operating business and the importance of technology, presented by John Murray, who is the president of Hospitality Properties Trust, which is one of the largest REITs, the largest publicly traded REITs on the stock exchange. So he will be here. The seminar actually starts at 6 o'clock. There will be refreshments, I think barbecue at 7 o'clock for anybody who attends the. And but for this reason, because there's a half-hour session with this guy before that, we need for any of those of you over there in the conference room, you do need to clear out of there at 5:30 sharp today. So, and then the seminar will be here. Yes, the seminar will actually be here at 6 o'clock. So, what we're going to do today is have really the last lecture on Module 1. Now, I'm not going to guarantee that I'm going to completely finish everything today, and I may pick up a little bit of loose ends on Wednesday. But the basic plan is we finish Module 1 today with Chapter 6, which is about market analysis, real estate space markets, and yeah. But actually, we're gonna start actually with the tail end of Chapter 5 about depreciation. Because I didn't talk as much about that on Wednesday last week as I wanted to, and because it was the first question in your homework assignment for today. Then the rest of Wednesday will be, we'll actually start material on Module 2. Module 2 is the basic financial economics of valuing real estate investments at the micro level. The most basic elemental stuff, focusing on individual properties. And we will start that material on Wednesday. I do not have you guys doing the homework for Wednesday. We're going to have the quiz on Module 1 a week from today. And I have to be out of town all of next week, effectively, both days next week. So the quiz will be proctored by our illustrious TAs. And we'll have the first homework of Module 2 and the introduction to the case that we're going to use in Module 2 a week from Wednesday, on October 1st. And the TAs will cover that session. So, what else? Any questions? All right. Seems to be a lag in my clicker. The first question that we had for homework today is indeed about the depreciation point. And let's suppose you've got a highest and best use as if vacant that's constant in real terms. Right? So unlike the exhibit that's in the book, in this case, we've got time here, and in the book we had the highest and best use growing, but now I'm saying let's suppose it's constant, which, especially if we're measuring in real dollars, net of inflation, that's probably a more typical and more realistic assumption. So this is what I labeled U, the usage value, and whenever we rebuild at these R points, we're going to build to that highest and best use. And there's some land value here, which is usually probably a more or less constant proportion of the total value. And in between the reconstruction points in time, the value of the property declines because this component here, the structure value, which initially equals the construction cost that you put in there, that depreciates over time. Right? And this part here is land. And we said there's two ways to define or conceive of land value. There's the value that this site would sell at if there was no structure on it, which is what I labeled L. But another way to think of it is the value of that call option. If you think about the value of the land as distinct from the structure is just the fact that the land gives you the right without obligation to tear down the existing structure and replace it with a new structure by paying the construction cost. So that's a call option. This value, label C. And this is our model, right? And here I'm giving you the parameters of it. And this is actually probably pretty realistic parameters for typical U.S. commercial properties. 100-year reconstruction cycle, and the acquisition cost or the land value as a fraction of the total at the time when it's optimal to rebuild, 25%. And let's suppose there's a 2.5% inflation rate. So these are the real numbers, net of inflation. But then inflation, devalues the dollars, and so you get a larger number of current dollars for each dollar of real dollar. So we want to see what's the real depreciation rate in asset investment, and then what's the nominal rate. And even though it's just the structure, it's just this part that's actually depreciating. What matters for the investor is the depreciation % per year as a fraction, not just of that structure component, but of the entire property value, the P component. Right? Because that's what you're holding, that's what your asset is, that's what your investment is. So the fact that some of it is land and it's not depreciating, that's all the better. I guess from an engineering perspective and from various accounting and tax perspectives, it does matter what is the percentage of the structure at the structured component itself that is depreciating. But from the investment perspective, what matters is the percent of the total property value that's depreciating, and that's what we're focusing on here. So everybody understands the conceptual point. So can we have a random student generator? All right.
Anirudh Rajshekhar.
Is Anirudh here?
Okay, then Ethan Lay.
I'm sorry?
Ethan.
Ethan?
Yeah.
Ethan? Hi, you want to have a go at this problem?
Yeah, sure. So the annual depreciation rate for the 100 years, basically just do like 0.25 times 1 to the 100 minus 1. So you get like a 1.3% as the rate, and then
Okay, so what we're going to do, we're going to take the 0.25 and raise it to a power, right?
the 1 over 100.
Right. You just take the ending, the ratio of the ending value to the beginning value, raise it to the power of the inverse of the length of time that it happens. And that's going to give you your compounded annual growth rate, which in this case will be a negative. It'll be a depreciation of, what was it?
1.3.
Okay. Negative point. Okay, so everybody agree? Anybody get anything different? And this is just explicating the whole thing. Right, so 1.4% per year of the property value. That's an average number, as if it would be a constant rate for the entire cycle, and it may not actually be exactly constant, but and that's in fact very similar to what we do find in the empirical study that I'm going to show you guys in a minute. But any thoughts or observations about that? So then, I'm sorry, I'll leave to, I was going to ask another student, but let's just do it this way. The other part of the question was, what's the nominal price trend of this property that is depreciating in real terms at 1.4% per year? And if we've got 2.5% inflation and 1.4% real depreciation, and what we're starting from is a constant value here. So, you know, the depreciation rate that we just computed here is actually a depreciation rate relative to the top line here, whatever that is. But I said, let's assume it's constant. So U has a change rate of 0% per year. So therefore, this 1.4% depreciation rate is relative to 0. So therefore, it's negative 1.4% in real terms. In other words, the P here is actually declining at 1.4% per year in real dollars. But if those real dollars are inflating at 2.5% per year, meaning it takes $1.02 this year to buy what $1 bought last year, then the nominal price path of P is going to be actually positive. It will actually grow at 1.1% per year in nominal terms, thereby losing 1.4% per year in real purchasing power terms. Everybody see that? So what we see in daily observations of the real estate market is the nominal, the current nominal dollars. So we see this property, this P, as not declining. We see it as increasing because we're measuring in nominal dollars. But you can see how that sort of masks a real depreciation process that's going on, and which will ultimately lead to it being profitable to demolish the structure and replace it with a new structure. Okay? So that's the essence of depreciation point. And now I'm going to switch over to another set of slides that I did post to the resource section because I want to show you guys I want to show you this research that we've been doing here. Sherry Bokhari, who is a postdoc researcher here, and myself have been working on a database that's one of the center's industry partners database, and it is, I think, the best database of commercial property transactions in the U.S. If you only care about properties that are like, big or medium sized, right? Their cutoff, their floor is $2.5 million. So properties that are smaller than $2.5 million are not in this database. And if you want that, the source of a database that has those properties is CoStar Group. But there is, you know, the really small properties are kind of in a class by themselves. Right? Those are the mom and pop properties. They get different types of financing. They really do different things. Many of them are owner-occupied businesses. And in terms of investment real estate, which is our primary concern in this class, the $2.5 million cutoff is pretty good. Almost all of the investment real estate, certainly all of the really professional, institutional kind of investment properties are pretty much greater than $2.5 million. So for that database, this is, you know, for that market, this database is the best. And so this depreciation study that we've done is, you know, not only more up to date, but it's on a much better database than any previous depreciation study. I say this because this is becoming, it's becoming a little bit of an issue because of the drive for greater, you know, for dealing with the budget crisis of the federal government in the U.S. And so Congress is looking for ways to raise more tax revenue. And one of the possibilities has to do with, well, maybe we're allowing commercial property owners to depreciate, to take too much depreciation expenses, and we could change those rules and get more tax revenue from them. And so there are some, you know, members of Congress that are exploring that, and so this is to have an empirical study which would update, because the studies that the present tax rules are based on are ancient, and yeah, they were done over a generation ago with not nearly as good databases, not nearly as sophisticated methodology. So that's kind of why we've been playing around with this, and I want to show you our results. Admittedly, this is preliminary, okay? We have a working paper presented in an academic conference. We haven't submitted it for publication yet. The point here is it's over 73,000 transaction price observations covering the period 2001 to 2013. And we are quantifying the depreciation, as I just pointed out, relative to the property value, not just the structure value. So we are relating it to P, which is, as I say, the number that really matters for the investors. And, you know, why does this matter? I've already talked about that a little bit, but just to reiterate, it's non-trivial. We find, you know, roughly 1.5%, very similar to the numerical example that we just did in the homework. This differs from what is typically assumed in real-world practice, where there's a very widespread assumption that rents are going to grow at 3% per year. Let me just try to get some confirmation on that from the real world. A number of you have worked in real estate investment, in U.S. Real estate investment properties. Raise your hand if the 3% number is something that looks very familiar to you. Right, okay. It's like it's just accepted without questioning. And this is in a world, in an environment where inflation has not hit 3% in, I don't know, 20 years. Although it's close, right? So the 3% is not a bad approximation of inflation, but if anything, it's slightly on the high side. Inflation tends to be a little below that in the U.S. And if we've got 1.5% of real depreciation, then to project your rents growing at 3% is not going to make sense, unless what drives this depreciation is not the failure, the inability of rents to keep up with inflation, but maybe it's what we call cap rate creep. It's the fact that as the building gets older, you have to sell it at a higher and higher cap rate. Then it could be consistent to have rents that are actually growing at 3%, but as the cap rate's creeping up there, the value of the building is declining relative to the rents, and that's what could be causing the overall decline in the value of the property. So we need to sort that out, and no previous study has tried to do that, but we do. And to cut to the chase, indeed, it's not cap rate creep, it's rents that drive the thing, so the 3% rent growth assumption is not realistic. So, you know, we use regression analysis to do this. We regress the prices that we're observing onto a bunch of attributes of the properties, and the nature of the transactions, and the control for where they're located, and the time dummies for, whether this was, the transaction was at the boom in 2007 or was at the bust in 2009. And among the property attributes that we have here, crucially, we've got age and age squared as variables on the right-hand side of the regression. And the coefficients that our model will estimate on those two variables will tell us the profile of property value as a function of age. So it's basically saying, how much less is 30-year-old building A selling for compared to otherwise identical, controlling with all these right-hand side variables, 20-year-old building B as of the same point in time, using our time dummies to control for that. So this is it's real inflation, it's real depreciation. Now,
what's the logic behind assuming age and age squared? Are you defining?
Well, this enables us to have a bending curve. It enables the curve, a parabola.
So you're defining that as a quadratic equation.
Y x squared, right? The parabola the x squared term enables the depreciation rate to bend. It doesn't have to be a straight line, which is probably realistic. We do this various different ways, including what we call a non-parametric or semi-parametric specification, where we don't force it to be quadratic, and you get a result that's consistent. So, so this is a kind of a parsimonious way to represent it. So we do not have data on how much the property owners are spending on capital improvement expenditures to improve their properties over time, which means the depreciation that we find is net of what already the landlords, the owners, are doing to keep their properties up. Right? Now, we do filter out of the database anything that we can identify that's a major renovation project or major rehabilitation. We're trying to be between these R points, not across them. So we're trying to filter out where there's been a major injection of capital into the property. But for the routine, routine operation of the properties, there's capital improvements that are made in the properties probably almost every year. And we're not taking that out. We don't have any way to take that out. So this is a result net of that, even after. So
I was not able to follow over there.
what's that?
Yeah, I was thinking the other room but couldn't follow. So
You couldn't follow? How come?
yeah, I mean, there were some slight interruptions
Yeah?
of the video.
All right. Well, we'll have
Sound was
to
not very good.
work on that.
Yeah.
So the other people are hanging in there okay over there?
Yeah, there are some people.
Yeah, there's actually a seat. Is that a seat?
Oh.
All right. So, okay. So you see what's going on here. Now, we're going to not only model the prices of the properties, we're going to model their cap rates that they sell at. We don't have cap rate data for all the observations, but we do have it for a lot of them. So by having separate models for the cap rates and for the prices, we can track this cap rate creep issue. Right? We can see whether the cap rates are also a function of the age of the property. So, so here's the big picture results that we find. Over the first 50 years of the age of the structure, the picture looks roughly like this. These numbers are actually a little bit different than what we ultimately end up with. Ultimately, we're going to end up with about a 1.5% average depreciation rate. But for the first 50 years, which for technical reasons, we kind of, some of our charts at this point in the study anyway, just look at the properties that are 50 years or less. Once we get older than 50-year-old properties, 50-year-old buildings, the data becomes problematical. We really have a survivor bias kind of problem, that we don't have the buildings that have already been torn down, right? And so we need to use some special econometric techniques to deal with that, which is why the study kind of is a little bit in two parts. But the point of this picture is that the red line here is the overall depreciation. It's the overall value age profile. So the value of the property, as evidenced by its transaction prices, as a function of the age of the structure, relative to or as a ratio of the value of a 0-year-old, brand new property, is what's traced out by the red line there. This is a age value profile of properties, and the green line is what it would be if there was no cap rate creep, if the cap rate remained constant, and you just had the effect of the change in the NOI, the net operating income of the properties as they age. The blue line is what it would be if the net operating income was constant, was not a function of age, and the only thing you had was the cap rate creep effect, the fact that cap rates tend to get a little higher as properties get older. And as you can see, there's almost no cap rate creep effect. It amounts to about 11 basis points per year rate over the first 50-year life of the structure. So depreciation is driven by what is happening in the net operating income of the property in the U.S. And I don't know if that would always be true. I'll talk more about that in a minute. But notice also this little bar chart here shows the depreciation rate per year of age as a function of the age of the building. And this is a depreciation rate of as a fraction of the total property value, right? Not just the structure component. And what you see is that there's actually greater depreciation per year as a percent when the buildings are younger. So this is kind of counterintuitive. You think brand new buildings not going to depreciate for a while yet anyway, right? Not the case. The younger buildings depreciated over 2% per year of the larger total property value up here. The older buildings depreciate really barely at all per year as a fraction of the even lower property value. Now, why is that actually very consistent with this picture? Yeah.
Well, I was just going to say, I mean, you're getting most of the values in the structure of the building.
Exactly.
So I was going to ask you as well to follow, what depreciation method are they using for this? Is it just straight line?
Well, so that's where our specification of the age and age squared comes in. So it's which is an approximation of an even more. We could have dummy variables for depreciation of buildings 1 to 5 years old, 5 to 10 years old, 10 to 15 years old, and so on. When we do that, we get a shape that looks very much like the quadratic shape, and so we just use the quadratic model. Also, the thing about the quadratic model is that it has a minimum point, which actually conceptually is important. If we used a function like just pure geometric and exponential model, there's no minimum point, right? It's asymptotic. Now, in principle, if we believe that buildings do ultimately get torn down, they don't live forever, then there does come a point, in theory, in principle, where the building is worthless. And so it should, and then it's not depreciating anymore, so that's a minimum point, right? So in theory, we should have a functional form that does have a minimum point. So, okay, so these are basically our results, 1.5% per year, which is, the numbers are pretty much what we just talked about with the homework assignment, right?
Wouldn't at some point a completely obsolete structure almost in a sense have a negative value because it's just a cost?
We have to demolish it.
Right.
Right. But I think usually the demolition cost is a small fraction of the total construction cost, and so we kind of tend to abstract it away. But you're right. The land value of a property encumbered by an existing structure that you just want to tear down is going to be a little bit less than the land value of a property that truly is vacant. Although sometimes there's some offsetting things, like maybe you can use the foundation or part of the foundation, part of the landscaping or something. You may be able to reuse some of that old building, which then might offset that consideration.
Is it possible for a building to get so old and obsolete that it actually starts to gain in value?
Absolutely, and I think there was a Stellar Forum post who did it. Yeah. All right, what's your name?
Leah.
Leah. So read the thread on Stellar about that. Yes, some structures are going to get so old they're going to become historic, and they're not going to depreciate anymore. But that's pretty rare, pretty unique. And
I have a quick question.
Yeah.
Your conceptual diagram here shows it structural value going down to 0 basically as it approaches land value. But your slides seem to show that it doesn't really quite go that low, like it was going 50%.
that's because we cut it off at age 50. I'll show you the more complete picture in a minute.
Okay.
Yeah, this is actually, when we do the extra econometrics to correct for the problem that we have the censored sample for really old buildings, this is our overall result. And this is our the estimated coefficients for age and h squared. And if you take the derivative of that and set it equal to 0, you're going to see that the minimum point occurs at age 128 years. And you can go further than that to, once you know that the minimum point happens at 128 years, and you know this age value profile for all the previous 128 years, which you know from this formula here, estimated empirically, then you actually put those two together, you know what the land value fraction is at the time of these reconstruction points in time, assuming that the top is staying constant approximately, which on average is probably a good assumption. So this is the overall picture. I have a bigger version of this. I guess not, but you can all see this, right? It gives us a land value fraction of 31% of the total. So in the homework I said 100 years with the 25% land value. Here we're finding actually 128 years with the 31% land value. But you know the difference with that you get there is not really economically significant. We got 1.4% in the homework solution. We're getting an average of 1.5% here. And that's partly because it's not a constant rate across there. So, but that's kind of the big picture of the results that we find, just in terms of magnitude of depreciation for commercial property. This is the 4 major types of commercial properties all over the U.S., all lumped together. Apartments, office, retail, industrial, metro areas all across the country. If you want to look, so here we're looking at the 128-year lifetime, life expectancy, and the orange curve is the fraction of the structure value that's remaining. And the blue curve is the percent per year of just the structure value that's depreciating. And notice that this actually rises, and in particular when the structure gets very old and very near its time of demolition, the structure has almost no value, which means as a percentage of the remaining structure value each year, it's depreciating very rapidly.
Mm.
So the surprising thing to us was the small role of the cap rate creep. The conventional wisdom and the typical appraisal assumption in a typical 10-year discounted cash flow is that the going out cap rate, the cap rate at which you will resell the property in 10 years, is going to be 50 basis points above the going in cap rate, other things being equal. So quite a bit of cap rate creep over 10 years, you get 50 basis points of cap rate creep. What we found is the equivalent of much less than that. Here I'm just showing, well, we're going to get into this in more depth in Module 2, so I don't want to get too diverted here. But this is the basic points about what you might call a cap rate life cycle. So the first point here is that the property depreciation rate decreases with building age, as a fraction of total property value. Simply reflects the fact that land does not depreciate, only the structure, and as the structure depreciates, it becomes a smaller fraction of total property value, exactly the point that was made earlier. So that makes sense. Now this would make the nominal appreciation or value growth rate increase with building age. Right? If the depreciation rate as a fraction of property value P is the depreciation rate is decreasing with age, then the appreciation is just negative depreciation, right? Depreciation is negative appreciation. So this would make the growth rate increase as the property gets older. Granted, it's growing from a lower value. The starting value is lower as a result of depreciation, but going forward, the rate of growth would be greater. So, and the cap rate, we've talked about this before, cap rate being Y, total return expectation on the investment, the discount rate being R, the growth rate being G, the cap rate is R minus G. So the cap rate would make the cap rate decline with building age. Rather than the conventional wisdom of cap rate creep, where cap rate increases with building age, you'd actually see the cap rate declining with age. But we don't see that either. We seem to get cap rate actually ever so slightly increasing with building age. Because there are two offsetting factors here. As the building ages, depreciation makes the structure value component of the property value a smaller fraction, and therefore the land value fraction increases as a fraction of the property value, right? Land value is more risky than structure value. A structure is like, it's an asset in the bank. A structure can generate cash flows, and you know the cash flows that it can generate pretty well. You can see what it's currently generating, and it's not going to change that much. It's already built, it's already there. Land is, as we said, it's a call option, and it's a residual value. When you get variation in the real estate market and it causes these values to go up or down, it's not because the cost of building buildings is going up or down with that kind of volatility. It's because the value of real property assets is going up or down with supply and demand in the, in the property asset market. And so it's the land value component that's moving up and down. When P goes up and down with volatility, it's the land component that's going, whether you measure it C or L, it's that component that's going up or down. The structure value component, the S, is staying pretty constant over time. So the volatility in real estate investments is really driven by the land component. So as the land component becomes a larger fraction of the total property value, the property becomes more risky. And therefore the R increases. The R is the opportunity cost of capital. It's the expected return the investor would require from the investment. And it equals the risk-free rate plus the risk premium. And if the property is becoming more risky, then the risk premium needs to increase. So the R is increasing over time as the structure ages between the R points. And the growth, the G, is increasing over time for the same reason that the land is becoming a larger fraction value, fraction of the property value, and the land does not depreciate. So we have these two offsetting factors, and that's how you can get a cap rate that doesn't change much with the age of the building. It's a coincidence for it to exactly offset each other, and that's why I don't think this would happen in every country. It's a function heavily of how big is that land value fraction at the time of redevelopment. And in the U.S., so it's like 30% or 25% or something like that. But what do you think that is in Japan, in Tokyo? Yeah, it's like up here. It's like the land is like 80% of the whole value, even when the structure is new. Or Hong Kong, 90%. I mean, we have already some empirical evidence of those places. So, so that would be a different situation. So then, why is this cap rate creep so small? Well, just what we said, we've got these two offsetting factors. Let me see what I'm trying to get at. Oh yeah. So it seems small because of this conventional wisdom that it should be 50 basis points of cap rate creep between a going in and going out cap rate over 10-year pro forma. And in fact, we get that it should be about actually a 7 basis points of cap rate creep if the going in cap rate is 6%, which would be typical today. Even if cap rates were in the 10% range like they were 20 years ago, or like they might be for some types of property, then still this amount of cap rate creep that we're finding equates to 11 basis points. But yet appraisers and underwriters are assuming going out cap rates 50 basis points above going in cap rates typically. And they are getting the correct present value for the properties, right? Because if they weren't, it would be glaringly obvious, and you wouldn't be able to square that with the reality that you can observe. So what's happening? If they are assuming a greater going out cap rate than is apparently the actual empirical reality, and yet they are getting the correct present value of the property, then what's going on there? What's wrong?
They're underestimating the NOI growth.
Allison.
They're overinflating NOI. They have unrealistically high NOIs.
They're using a cap rate that by itself, if everything else was correct, would give them a present value that's too low. So they must be doing something else in the equation to make up for that, namely making something else that would give them a higher present value. And what they typically do is, what we were just talking about, they're growing the rents at 3% per year, when, as we just saw, the rents are actually growing more like 1.5% per year. So those two mistakes offset each other within the, actually there's a third important variable, which is the discount rate that they use. The combination of the going out cap rate being too high and a discount rate that they're using probably also being too high, combined with a growth rate in the net operating income that they're projecting being too high, those things all offset each other and you get the correct present value. So this, in a nutshell, is what goes on a lot. And actually, this point here, I diverted to talk about it now. It's a point that arises in Module 1, as we talk about the fundamentals of this. I guess this is part of urban economics. But this is a very important point in Module 2 as well, as you'll see. They come out a lot in Chapter 10 and Chapter 11, which we're scheduled to start to talk about on Wednesday anyway. So if I don't finish all of what I was going to cover about Chapter 6 today, that's okay, because I've already just covered some stuff that I was going to cover on Wednesday, or that's relevant to Wednesday. I could do it either day, all right? You need this flexibility.
So when we go into the second module, we want to estimate how much the risk premium should be and estimate the discount rate and show that
we're going to talk about that. Yeah, in Module 2, finance question. In Module 2, we will talk about what that risk premium should be in the discount rate. All right, it goes on. It goes on. But I'm going to just quickly point out some of the more interesting features here. The depreciation rate differs. This is the number, the sample size. The depreciation rate, well, first of all, it does differ between apartment properties and commercial properties, which is slightly interesting because the tax rules allow you to use a different rate for residential and for non-residential real estate. And what we find is that, yeah, apartment properties do depreciate a little faster than non-residential commercial properties. But on the other hand, also, at least in our sample, which as I say is a pretty good sample, the average apartment property is older than the average non-apartment property. So we actually, the way that shakes out in terms of the profile is the rate per year at the average age is actually slightly lower depreciation rate for apartment properties than for non-apartment commercial properties. We can break this down by industrial, office, retail, apartments, and then as a function of the age of the structures. And what I think is, and I don't have that much to say about this at this point, but obviously any kind of building, the depreciation rate declines with the age of the structure for the reason that we talked about, that the land becomes a larger component. This, I think, is very interesting. The depreciation rates as a function of building age, or if we take an average across that, across all the metro areas that we have a good sample size for. And here we've ranked it from fastest depreciation to slowest depreciation. And you see properties that have low land, metro areas that tend to have low land values depreciate at faster rates than metro areas that tend to have high land values. And so that makes sense. And it's a fairly substantial difference. It's basically, between the extremes, it's about a 200 basis point difference. And if you think about that in terms of property values, other things being equal, if a typical cap rate is, say, 7%, then this is the difference in the growth rate. If we would hold the risk constant, so the R, the discount rate, is the same, and then that would mean a difference between, say, an 8% cap rate in Dallas versus a 6% cap rate in Los Angeles. So that means that a property that has the same income is going to be worth, what, almost 30% more in Los Angeles than in Dallas. And that's because of the greater expected growth rate in the income in Los Angeles, and that's because of the greater land value fraction, the lower depreciation structure fraction in Los Angeles. Yeah.
In the 50-year column, we see that there are a couple metropolitan areas, mainly non-land constrained younger cities that are starting to uptick.
Yeah. Yeah, if we want to take that really literally, it's saying that in San Diego and Dallas, by the time properties are 50 years old, they're fully depreciated. The structures are fully depreciated, and it's just all land value. Now, you might want to think that's because they stop depreciating because they're historic structures. Where else do we have it? We have it in Phoenix. You know, historic structures, and they're brownstones in Brooklyn, but we're getting this in Dallas and Phoenix, and I thought we also had it in Miami. Where? South Florida, yeah, that's Miami. Yeah, that's the big one, actually. That's the one that does it the most.
Is it because those houses built years ago are being redeveloped or are at a higher value?
Yeah, it's because these are very dynamic metro areas where the metro areas are, expanding or their usage characteristics are changing rapidly. The highest and best use is changing rapidly over typical given sites. And so, so you get what we call economic obsolescence, where the existing structure, which was, built for the highest and best use at the time when it was built, which may be single-family housing, but by now already the optimal use there is multifamily housing or commercial or something. So they've become economically obsolete. So, but I wouldn't take these numbers too literally, because when we get, it's more the notional or the stylized result that I do think makes sense. But when we get to these sample sizes for these individual metros, there's going to be a lot of instability or error in the specific numbers. But it's just a rank ordering there, and their standard errors, and so this is South Florida, and this is as a fraction of the total property value, and this is where you see the fact that the depreciation totally runs out by the 50-year mark. This is Los Angeles on the same scale, so hardly any depreciation in Los Angeles. This is Dallas. Dallas, Los Angeles, Dallas, same scale. Real estate investment has a very different characteristic whether you're in this world or this world. Here it's much more of a growth play, and here it's much more of an income play. And this is important stuff for investors to realize and think about. And it also has to do with you can think about why the land value is greater in Los Angeles than Dallas, and because that's what's driving this difference. And you guys who have familiarity with those two cities, or we can use it. It could be Los Angeles, or it could be San Francisco, or it could be New York or Boston. On the one hand, it could be. We can look at our list here. Think of these cities down here: Seattle, New York, Seattle, San Francisco, San Diego, Boston, LA, versus these cities up here: Dallas, Houston, Austin, Pittsburgh, Charlotte. What's the difference? What's really the land value is the difference, the land value fraction, but what causes that?
the easy constraints on expansion of the city at the boundary.
Right, so what would be making those, so you're saying these cities are more constrained in their ability to basically feed more land into the development process. What makes these cities more constrained compared to these cities?
Is it related to the immigration and the income and the population?
Well, immigration and income and population, that's on the demand side. That would be causing there to be growth in demand. And this, I think there's growth in demand in all these cities, right? LA, Boston, San Diego, these are all growing cities, they attract immigrants, but so does Dallas, Houston, Austin. These are all growing cities. Well, maybe not Pittsburgh, my hometown, but it's starting to turn around. But we're focusing here on the supply side. What is making the supply side more restricted here? Supply, meaning supply of development, of new development. What is making it more restricted here compared to here?
Difference in zoning laws, which makes
So it could be partly regulation, zoning, building permits, the approval process of the development process. And that's really a function of the local political process, and that's a function of the local political culture, which is, these cities may have a lot less value. Their citizens don't value more growth as much as the citizens here. Or put it the other way, these citizens here are happy to sort of put restraints on growth more than these citizens here. Or whether it's the citizens or whether it's the political powers that be, whatever. It's a function of the local political process. That's one reason, but there can be another really important reason. Yeah.
Looks like the bottom ones are typically ocean.
Exactly. Physical constraints. Oceans, lakes. Oh, where's Chicago? Chicago's kind of in the middle. But oceans, lakes, mountains that are too steep to build on, swamps you can't build very well on. So there are physical reasons as well as political or regulatory reasons that cause the constraints to be different. And then there can get to be a kind of a feedback loop where, because these cities are constrained, investors perceive them as being a better investment. Because investors are coming in on the supply side, right? As part of, their assets are then part of the existing supply. If that supply is relatively protected against new competing supply, as would be the case in these cities, then investors feel safer that this is going to be a more solid investment. And so if more investment money flows to these cities compared to these cities, that's also going to have an effect on the cap rate, right? And so all stuff to be thinking about and sort of to keep in mind as we progress in the course here. There's just some showing you the profiles, the age value profiles for some of these different cities. You see how Dallas has really sharp depreciation at first and then levels out as basically a very dynamic metro area where you get a lot of economic obsolescence. There's our South Florida bending up. Los Angeles, almost a linear thing, very shallow slope. Boston looks particularly linear. So here we're scatterplot and regression of the cap rates, the transaction cap rates on the vertical axis, and the depreciation rate that we find on the horizontal axis, and the observations are these metro areas. So what would you expect here? If cap rate, so at least approximately, it's this thing I call Y, the income yield, and that equals the total opportunity cost of capital, the total investment return requirement, R minus the growth rate. And where does depreciation come in here, come into this picture? It comes into the G, and basically, for every 1% increase in the depreciation rate, that's a 1% decrease in the growth rate. Growth is positive number. If we're regressing cap rate onto depreciation, what should we find? should be almost a straight line, right? It should be almost a one-for-one correspondence. I mean, a 1% increase here, got a minus sign in front of it, so it should be a minus 1% here, but it's a one-to-one relationship. And we do find that as depreciation increases, the cap rate increases, right? So as this number, as depreciation increases, this number gets smaller. We're subtracting smaller numbers, but this number gets bigger. Right? Higher cap rates associated with higher depreciation, lower appreciation. So that's these cities up here: Houston, Dallas, Austin, etc. And here's the low depreciation, low cap rate cities here. So we have a very strong positive relationship. R squared at 35%, T-stat 3.5. It's a strong, it's a 59% correlation. It's a strong relationship. It's in the direction that is logical and rational and makes sense. What's interesting, though, is that it's only a 0.47 coefficient. So apparently depreciation is not the whole story with cap rates. It's about half the story. But it's half the story. And cap rates are huge drivers of real estate value. So there's other things, obviously, that are going on as well. Here, we're getting at that question of what's the source of the land supply constraint. So here on the vertical axis is the depreciation rate that we're finding. Again, our observations are the metro areas. So the depreciation rate on the vertical axis, and on the horizontal axis here is a measure of development supply elasticity developed by our own Albert Site. And what we see is that we have a very strong relationship, 75% correlation, 56 R squared, T-stat of 5.4. So as the supply elasticity, effectively as development supply is more elastic, meaning a small increase in the price of the property engenders a big amount of new supply being added into the market, you get lower land values and less, more depreciation, less growth, and so you have you have less land values, and therefore structures a greater proportion of the property value, and therefore depreciation is what's driving this model here. So a very strong relationship between development supply elasticity and land values, or the structure component, the structure fraction of property values, and therefore the amount of depreciation. Okay, that makes sense? Now, with that in mind, let's look at this, which is, this is an index just of land regulation. So this is total supply elasticity of land, or development really. And from whatever reason, it could be the physical reasons that are constraining it, it could be the regulatory political reasons. This is just the regulatory reasons. And we do get a relationship, so the more heavily regulated, the more restrictive a metro area is, the higher on this index here. And here again, it's our depreciation rates. So we do get lower depreciation in areas that have more regulation. It's harder to add in the supply. So the structures that are there don't have to compete as much with new competing structures. They hold their value more. But this is not nearly as strong a relationship as the relationship that's based on the total supply elasticity, which means that both of these sources of land constraint, if you will, or development supply constraint, the political regulatory source and the physical source, are both coming into play. In fact, if you drill down further with this, the physical source seems to be maybe a little stronger at driving these results than the political regulatory source. And this is actually an area of research that Professor Seith is one of the leaders on, and is has explored in a lot more depth. So you can talk to him about it if you're more interested. But that's really. Oh, I'm sorry. I did have another one here. So this is the regression that we get with just the regulatory effect, and this is the regression we get with just the physical constraints from Professor Seith's metrics. He uses satellite photographs and radar images to like very precisely identify the physical fraction, the fraction of land within, say, a 360-degree, 30-mile radius arc from a central point in every metro area, the fraction of the land in that arc that's developable. So it's not developable if it's water, it's not developable if it's swamp, it's not developable if it's a slope of more than, I forget, 10 degrees or something. And using those criteria, he can come up with a developable fraction for each metro area in which he develops this index, and that has a more powerful predictive effect on the depreciation rate than the regulatory index that Wharton produces that Albert's also been involved in. Yeah.
Will it be true if we run the same regression outside the US?
Yeah, great question, and we'd love to do that. I think this can change a lot in different countries because of the sort of the fundamental land supply demand balance. Right? The U.S. is fundamentally still a land-rich country. There's a lot of land here. And it's also cultural. You know, we've talked about how the different cultures have different preferences for living in dense situations or not. And there's also things relating to the transport policies, transport infrastructure policies of different countries and so forth. So I think this can vary a lot in different countries. Yeah. Okay. So, and I guess I did take a lot of time with that, but I think it's interesting, important stuff. And it's cutting edge. I mean, you guys are, you know, the first to know. Questions or summary observations before we go back to the chapter 6?
Can you explain why LA has the lowest appreciation rate? I would think that other land-constrained cities like San Francisco or New York would be closer.
Well, like I say, don't take those precise results too seriously. I think that it could be partly just some of the nature of our sample and the other control variables that we have. You know, they're not, that model's not fully complete. We don't have data on some things that could be important. There's some omitted variables. So I would say, you know, all those cities that were in the bottom 5 or half dozen or so down there, I wouldn't necessarily distinguish among them. One thing we did notice is that, for example, to give you a flavor of it, we were surprised that the depreciation rate in LA was lower than in New York. And these are metro area databases. And so what we then found out is that so these are properties of more than 2.5 million, income producing properties of more than 2.5 million, right? It turns out, not surprisingly, in the New York metro area, a larger proportion of those properties are apartment buildings than in the Los Angeles area. And in the New York metro area, while there are a lot of apartments in Manhattan, relatively speaking to other types of commercial properties, a lot of the apartments are in the boroughs, or even in the suburbs. Whereas, say, in Los Angeles, out there it's all single-family homes, and we're not getting it in the database. We're below the 2.5 million threshold. So, so the fact that New York is seeming to have more depreciation than Los Angeles is more the difference in the sample mixture than the fact that in the actual depreciation rates, if we could control more precisely for the type of property and location of property. All right. Well, we then turn back one last time to the Walden case, and we want to discuss the history of supply and demand for the office product in the Northwest suburban market. Should we go back and do a random student?
It is Josh there.
Josh. Josh, I can't see what. Josh, raise your hand.
Right here.
Oh, okay.
Okay, so basically the demand in the suburban area where the case is at was growing out basically along corridors, so arterial nodes and things like that.
But how do you know demand was growing?
Well, the case was basically predicated on the fact that like they saw this wave coming out of office supply, of office demand, kind of trying to get out of the city, right?
Okay, yeah. Okay, so demand was growing, what about supply?
Well, I would assume supply was also increasing with that demand.
I think what I was trying to get at here with this first question is really to try to focus you on the vacancy rate in the market, because
Okay.
the vacancy rate is kind of an indicator of supply-demand balance, right? I mean, you've got demand can be growing, supply can be growing, but if demand is growing faster than supply, that's a very different situation than if demand is growing but supply is growing faster than demand, right? Because what's really going to matter for development decisions or investment decisions is what's going to be happening to the rents and the ability to generate cash flow. And the vacancy is a good indicator of that balance. So, and the case gave you, right, we have Exhibit 7 here.
So demand
I mean, you can discuss it qualitatively with this question or quantitatively with this question, is what I was trying to get at.
Yeah, so demand was shrinking, right, because vacancies were going up and rents were going down.
Okay. So demand was growing, certainly it was, but maybe paused at some point in the late 80s, early 90s. But it would grow again, you know. Fundamentally, demand is growing out in suburban Boston for office space, at least, you know, with some hiccups, but it's basically growing at least until this century, right? So, so that's going on the demand side, but supply also growing, right? Plenty of development happening out there. First on 128, then on 495. So the balance, what's happening to the balance?
Bounces off. So obviously,
Which way to go?
it's oversupplied for the demand.
Okay, so at the beginning of the case in 1984,
Yeah, in 1984 was kind of an inflection point.
okay, vacancy was low back then.
Right.
And sorry, wait. But started to increase. Right, so you're right, it was an inflection point. And maybe Lindy didn't realize that yet at the time. So, I mean, vacancy was low, and let's say vacancy starts to increase, but that's market vacancy. We're going to build a brand new building, we're going to lease it up. We're going to, you know, so the market vacancy is not going to directly affect our net cash flow. But what is going to affect our net cash flow is the rent at which we can lease the building up, right? And how is the market vacancy going to affect the rent that we can lease it up? And we initially projected a rent of $23.50 back at a time, 1984, when the vacancy was low. So let's say vacancy has now risen a bit. Are we still going to be able to get the $23.50? That's the crucial question. But maybe we could. Maybe if vacancy just went from, say, 7% to 10%, that's not a big deal. We can it's still basically a balanced market. But what if it goes to 15% or 20%? This is what I was trying to get you guys to be thinking of. Matt?
That data set that Exhibit 7 provides, you can take an average of that for the decade and come up with an average vacancy for that submarket.
Very analytical. He's taking the data and he's inferring from it. So what was that average?
It was about 16.29.
16.29% must be our natural vacancy rate. If vacancy is above 16.92%, rents are going to have to fall. If vacancy is below 16.29%, rents are going to be able to rise. Now, that's way too precise, way too black and white and strong of a statement, but that's kind of the essence of what we're trying to get at here. Yeah.
Why would that necessarily be the natural vacancy rate? If the market was really hot in the early 80s, isn't it possible that like an excessive amount of supply would have come on board as the market was seizing up, driving those vacancy rates to be abnormally high in the late 80s and early 90s? So does it
Yeah,
make
I think that's
sense?
the point, right?
But does it make
The point
sense
is that the
that-
natural vacancy rate is where it would tend to go back to, and so what you're saying is that there would be that because vacancy rates were low in the early 80s, driving up the rents, bringing in now the new development, exactly the kind of thinking that maybe Lindy was doing. People are seeing, oh, the rents are high, they're growing, vacancy's low, we can build more space and rent it out. So, but it overshoots. Too much of that happens. It overshoots either because too many developers, or because the economy changes and demand stops growing so fast. Some combination of that, and so we end up with vacancy rate now in the late 80s that's above the natural level, which is now putting competitive pressures to drive rents down.
Is that 16% reasonable for?
Well, okay, let's talk about that. And first, let me begin by saying nobody ever knows the exact natural vacancy rate for any market. Too fuzzy of a kind of thing. There's a lot of concepts in real estate investment that are very good conceptual constructs. They make a lot of sense theoretically, but we can never quantify them precisely. And it's not just that we don't have enough data and we have better econometrics so we could do it. It's because the world is not that precise or complete, and it's not that stable, and it changes. So we're never going to be able to know exactly what the natural vacancy rate is in Northwest suburban Boston, but we can get some idea about it. Yeah, Matt?
I thought about the same thing that Mike's bringing up, and of course we don't know because it's a limited data set. We don't have the center of Boston's vacancy rate in the study, but we do have something from Atlanta in the chapter, which was about 15.
Right.
And knowing that Northwest Boston is at the edge, and so supply is a bit easier to come on.
Okay.
And then maybe also that you get those kind of dips where it goes to 20 and it goes to 14. We
Right.
see it kind of coalescing around a natural 16 seems maybe plus.
Yeah. It's such a fuzzy thing that I don't even like to think in terms of numbers like 16. I like sort of round numbers that are like multiples of 5, like 10% or 15%, like one. But no, maybe like 12.5% or yeah. But also, those of you who are taking Professor Wheaton's class, ask him about this, or he's going to teach you about it anyway. He's a lot more of an in-depth expert on space market than I am. But yes, sir.
Yeah, I had a question as far as, if you look at that the vacancy rate data, is there any evidence in your opinion to suggest that there's more, at least from the supply side, that they're willing to take as far as rent per square foot? Because towards the latter half, it seems that the rate creeps up even into the 20s, but the average square foot is not really meeting that.
Right. I do think that, well, here, let me just cut to the numbers here. During the period of history that we have that data in Exhibit 7 and that Case was dealing with, the bars here are the vacancy rates, and it was generally rising and then staying at a high level. And the average seems to be eyeballing it. Matt computed it exactly. I pegged it at a roughly 15%. And therefore, whenever vacancy is above that, you're going to have downward pressure on rents. And in terms of the evidence that we have in the case, the rents were pretty much falling for the whole period that we had the evidence for, but during that whole period, indeed, vacancy was above the 15% number. But if we roll this forward, and this is numbers for that market in the subsequent years, this is starting in 1989 and going all the way up, basically through the financial crisis. The blue line is the vacancy rate on the right axis here. And so vacancy peaked around the end of the 1980s, early 90s, and then started plunging down and bottomed at the end of the 90s, at the end of the dot-com boom, and then soared up with the dot-com bust because the Northwest Boston office market was very much a high-tech office market, and then declined again with the growing economy of Boston in the first half of the decade, and then began to rise again with the financial crisis and the recession that came on. Rents are moving just opposite to vacancy, and the rents are also pegged on the right-hand axis here. these bars are the construction and absorption as a percentage of the existing stock each year. So the purple bars are how much new space is added into the market. The green bars is how much new space is absorbed, namely is leased up in the market each year on a net basis. And in general, you have, well, obviously, the change in the vacancy rate is a direct function of the the difference between those two columns. And so when the absorption is exceeding the production, the construction vacancy is falling. And if we try to peg what would be sort of the natural vacancy rate by eyeballing eyeballing when the rents are rising and when the rents are falling, it would look like a vacancy rate of around 15% would have been seeming to behave as though that was the natural rate, sort of the balanced market indicator up through the 1990s. Because whenever vacancy was above 15%, rents were falling. Whenever blue line is above dashed line, red line falling. Whenever blue line is below dashed line or red line rising, seems to indicate roughly 15% is the balanced market indicator, the natural vacancy rate. But then, as Lyndon is suggesting, it seems like more recently the behavior reached a different behavior. The regime changed because even with 20% vacancy, we have, or with vacancy above 15% anyway, we have rents rising, and so maybe the natural vacancy rate is ratcheting up to 20%. And I don't know why there would be a shift like that in the natural vacancy rate. There could be various reasons. It could also be the data. I forget the source of this data, but all of this kind of data is soft. It's a function of how well the surveyors are gathering the information from the market and how the respondents of those surveys are responding to it, right? And it could be maybe that we're simply getting better at measuring and identifying how much vacant space is actually out there in the market. It's not a super trivial exercise, and I'm sure Professor Wheaton will tell you more about this. But for example, suppose a space is leased but not occupied, and it can be subleased. Is that vacant or not? It's paying rent to the landlord who owns the property, but in terms of the space market, that space is out there competing with other space to get tenants. Suppose it's space that is leased and unoccupied and not being subleased. What about that? Why should that exist at all? But a lot of that happened in the financial crisis and in the recession afterwards because companies downsized, where they didn't want to, default out of their leases. And furthermore, they maybe wanted to keep some of that extra space around anyway because they're hoping to expand again in the future. So that's what you call shadow vacancy. It's not space that's on the market right now. It's not competing for tenants. But when the market turns around and those existing tenants start to grow, they won't need any more new space because they got plenty of extra space in the leases that they already have. So these definitions are fuzzy. And when a company does surveys and they ask for, they ask landlords or brokers how much of the space is occupied and so forth, it can get inconsistent. And so maybe that's explaining the result. But so that's kind of the point of that part of the homework, and it's kind of the last thing that we're going to do with the Walden case. In the 2 minutes I have left, let me give you a quick overview of what else I will try to cover at the beginning of class on Wednesday, just to indeed make sure we cover so the sequence of slides here. This is all material that's in kind of the body of Chapter 6, which is just classical real estate space market analysis. The classical 5 variables that you try to track in the markets: vacancy rate, rent, new construction starts, new construction completions, absorption of space, how much of that, how much of the new leases signed are actually new people coming into the market versus just people moving around within the market, difference between gross absorption and net absorption. And the concept of a natural vacancy rate. I'm not going to try to cover all of this in depth and detail in class. I think it's pretty well explained in the book, and I do want you to read the book. There's a couple of indicators here that are very widely used. So month's supply is a measure of how tight is the space market, how feasible is it to develop new space into the market. If you count up the amount of vacant space that's in the market, you add to that the amount of space that's under construction in the market, and you compare that to how much space is being absorbed in the market, in other words, the net growth in occupied space in the market, and you measure that in terms of months, and then you compare that, or you relate that to how long it takes to develop new space. So let's say you've got 20 months of supply, and it takes only 12 months to build a new building, then can you build new buildings or no? No, you gotta wait another 8 months before. Otherwise, you're gonna build your building and it's gonna there's still 8 months worth of supply already out there. But that's a very crude and simple way of looking at it. You can enhance the measure a little bit. But the point is, you have these common metrics that are often talked about. I want you guys to know what they mean, how to compute them. We'll take a little bit of time to look at our specific examples that already Matt mentioned, looking at one of them. We have New York, San Francisco, and Atlanta on the same scale. Construction, absorption, and as a fraction of existing space. Construction, absorption, and vacancy and rents. And talk a little bit about those three different markets and how they're behaving differently, but we'll do that on Wednesday. And then, of course, we will get into the stock flow model a little bit. Hopefully you guys had a little fun playing around with that. Those of you taking Professor Wheaton's class will get in a lot more depth on these kind of models. He kind of invented these models. But this is a fun model to give you some intuition about what all can go on in the real estate space market over time. So I'm going to stop there because especially the people over there in the conference room need to clear out of there.